Welcome to your weekly mortgage rate update. I'm Tyson Underwood. Mortgage rates have been drifting higher for most of the year due to sustained inflation and the reevaluation of the Federal Reserve's monetary policy path. While newly released inflation data from March continues to show a trend of very little movement, the financial markets reaction paints a far different economic picture. Since inflation decelerated from 9% to 3% between June of 2022 and June of 2023, the annual growth rate of inflation has remained effectively flat, ranging from 3.1% to 3.7% and averaging just 3.3%. The March estimate of 3.5% annual growth is in the middle of that range. However, the market's reaction was dramatically different, as illustrated by a significant drop in the stock market and a massive sell-off in the bond market last week. Now, it's clear that while the trend in inflation data has been close to flat for nearly a year, the narrative is much less clear and resembles the unrealized expectations of a recession from a year ago. Please subscribe to my YouTube channel and take a look at my video on what drives mortgage rates and what recession means for the direction of rates. Rate update, the 30-year fixed averaged 6.88%, up from last week when it averaged 6.82%. Now, I'm going to tell you ahead of time that next week's market update is going to look dramatically worse, as we've just seen a 0.25% rise in rates in just a little over 3 days. For those of you in the middle of a purchase or refinance transaction, don't worry, rates will get better. The outlook on lower rates is still coming. It's just now pushed out to later in the year. Thanks for tuning into this week's Mortgage Market Minute. I'm Tyson Underwood.